Yep. As a client wants to know, if someone wants to do a 1031 exchange but can't find a new property in time, what can they do to avoid paying taxes?
So this is a funny question because this is one where it doesn't really depend. So
Right.
either you meet the timelines or you don't. There are all kinds of stories in the real estate investment world talking about this situation where they have a 1031 and they need a property now and they're just looking for any kind of anything that they can roll it into. If you miss the deadlines, which is basically a 3 month and a 6 month deadline, then then it's taxable. That's basically it. I'm not aware of any exception to that if you miss the deadlines. Now, there are other things you can do though, like reverse 1031s, where you buy that property before you sell the other one. I was talking to a client this morning who did that last year with a condo. But yeah, if you miss it, it's taxable. So here's the question. In that situation, is it worth buying a bad deal in order to avoid the tax penalty? And the answer is usually no. Because you're going to have, if it's a long-term capital gain, which most 1031s are, the vast majority are, then you're going to be paying 24% at the top, 23.8, or I always round to 24%, state, federal, and usually average state rate is going to be 5-6%. So let's call it 30% all in on your gain. So is it worth paying, or is it worth buying a bad deal in order to avoid a 30% gain tax? And it depends, right? It depends on how bad a deal is it, right? And the thing about real estate is because it is so illiquid, if you get into a bad situation, it can go against you in a hurry. So a lot of commercial real estate guys are finding that out right now as the mortgage rates are being reset, because most commercial real estate are in 5-year arms. They'll reset every 5 years, basically, on interest rates. And when they bought the property back in 2019, rates were a lot less, 4%. And now they're a lot higher for commercial, 8%, 9%, 10%. And so the underwriting of the properties changes as the interest cost changes. And so what was a deal in 2019 is no longer a deal in 2025 just because of the financing underneath it. And so if you run into a situation like that, then it would have been way better to take the 30% hit on the tax than it would have been to get into the bad deal and lose 100% of everything. You have to be really mindful of when you're doing these kinds of things, of the long-term ramifications, how exposed you are to interest rates, and then how bad of a deal do I want to accept if it's a rush job, and are these potential negative outcomes out there compared to my just paying the tax, right? So in a 1031, you basically have 3 months to identify the next property, and then 6 months, and then additional 3 months, so 6 months total to close on it. And it doesn't have to be one for one, so that's something to keep in mind. So you can identify a bunch of properties, and you don't necessarily have to close on all of them. So it's just like, hey, these are the ones that I'm wanting to look at, and then you can get your extra 3 months to close. But then if you don't close in 6 months, then it's just taxable. I thought it didn't depend, but it does.
Right.
Yeah, that's the basic idea there. I do not, so in the real estate thing I put up here, 1031s are not included because we're talking about, this course is talking about operating deductions rather than purchase and sale kind of stuff. So it's unlocking those passive losses that are during the course of your ownership to offset other income rather than trying to minimize tax savings minimize taxes on the exit. So just be aware of that.
Alrighty. Now we have another question under real estate. Someone wants to know, if a landlord also uses part of their rental property for their own business, can they still do a cost segregation study?
For their own business, yes. So, if the business is a tenant, then that's fine. It's just like any other tenant. You gotta play fair though. So where people get into trouble is when they give special deals to their business, or like a family member or a friend or something like that. You got to charge market rates. As long as you charge market rates, everything's fine. But if you give yourself a sweetheart deal, then you can run into potential issues. It could be considered a gift. It could be considered income. It's just weird stuff happens. So just charge market rates, and you're fine.
Right.
Now, if the landlord himself or herself is actually occupying the property, then you have to discount out that personal use portion of the property, and then you can segregate the rest for investment purposes. So that's a little wonky. That's not something we see very often. It could happen.
Alrighty, so it looks like we have a captive insurance question.